It's a wet and windy one here on the beach. Tropical storm force winds, in fact, gusts exceeding 60 miles an hour at this location within the past few hours. With that storm stalled 100 miles off the coast, this area is just waiting to see what Dorian will do.
Well, it's that time of year again. That is the stormy time. And we're not just talking about the weather. Late summer has always been an especially tumultuous time for Wall Street. The question becomes, will fall bring calmer conditions, or will it bring the perfect storm? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies and new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. As I'm sure you're aware, these are crazy times for the financial markets. After hitting new record highs in late July, each of the major stock market indices started August with a precipitous drop. The market regained some of those losses only to drop again the following week and then repeat the cycle all over again, so far going into September. Now, as you're probably also aware, the driving force behind much of the turmoil has been the Trump-China trade war. But many other factors are now adding to the fear and uncertainty, from our inverted yield curve to the president's continued criticism of the Federal Reserve. The big question for investors is this: will this storm blow over, or is it a lead-in to the next major sustained market correction? We'll examine that question and many more with our panel of guests on today's show. Joining me will be CNBC's John Najarian, an investor, money manager, and media analyst. John's also co-founder of Investitute, along with Scott McLean, the head of McLean Tax Advisory Group in Waretown, New Jersey. Scott's also the author of a new book coming out soon called Three Blind Mice: How Today's Financial Planning Process Leads Your Money to a Mousetrap. As well as Eddie Ghabour, the co-owner of Key Advisors Group in Lewis, Delaware. He's also the author of the new book, The Common Sense Bull. But first, let's recap some of the major developments we've seen since our last market update show. Shortly before the G7 summit in mid-August, President Trump's trade war with China heated up again as both sides announced plans for new tariffs. On the same day, the Dow Jones Industrial Average dropped 623 points, while the S&P 500 closed about 6% off its record high. The market recovered most of those losses, only to suffer another major intraday drop on August 22nd. This one, again, attributed mainly to fears about another potential escalation in the trade war. In the end, August was the stock market's most volatile month of the year since actually the month of May. But in the bigger picture, Wall Street has actually been caught in a storm of uncertainty. When? Since early 2018, over a year and a half, when President Trump first began tweeting about tariffs and the possibility of a trade war in the first place. Despite briefly hitting new peak highs in July, the market was once again below its peak from January of last year, as recent as early September of this year. In other words, it's basically been trading sideways for over a year and a half, and experiencing during that time bouts of higher volatility. Now, while the trade war has been identified as the main culprit by most economists, there are now plenty of other factors worrying big investors. Perhaps the most significant is the full inversion of the U.S. yield curve, which occurred in August and sustained right through the beginning of September. Now, while I've been discussing the significance of a flat or inverted yield curve for several years now, most of the financial media has only just recently started paying attention to it. In fact, it started making headlines on December 3rd of last year when the yield on the 5-year note fell slightly lower than that on the 3-year note. But that was only the beginning. The inversion culminated in mid-August when the yield on the 10-year Treasury fell below the yield on the 2-year government note, and the 30-year bond closed below 2% for the first time ever. The 10-year yield was already lower than the Federal Reserve's benchmark short-term interest rate, despite the Fed lowering interest rates to 2.25% at its meeting back in July. Now, In a normal yield curve, short-term bills yield less than long-term bonds, and investors expect a lower return when their money's tied up for a shorter period of time. Of course, right? But when a yield curve inverts, it's typically because investors have little confidence in the long-term economy. That's why an inverted yield curve is said to be one of the most accurate indicators of a coming recession. And history bears this out with accuracy over and over again. According to studies, an inverted yield curve has preceded every domestic recession since 1955, including, yes, the Great Recession from 10 years ago. Now, obviously, a recession is the worst thing for the stock market, which dropped by nearly 60% in conjunction with the Great Recession, marking the second major sustained market drop of our current, what I believe is our current long-term secular bear market cycle. So, is the storminess and volatility we're seeing now a warm-up for that overdue third major sustained drop? If so, what will be the actual tipping point that triggers that sell-off? There are a number of possible answers to that question, and we'll talk more about that coming up in just a bit. And right now, let's welcome our first guest, John Najarian, a well-known investor, money manager, and media analyst on CNBC's Halftime Report, as well as Fast Money. He's also the co-founder of Investitute and has 25 years experience working as a floor trader. John, welcome back to the Income Generation.
Great to be with you, David. Thank you very much.
So you probably don't remember this because you're on TV a lot, but when you were here last time, it was December, and we were all up in arms because the Fed was threatening to raise interest rates 4 more times. And you said, everybody relax, that's not going to happen. The Fed is not going to be as aggressive as everyone thinks. But be honest with me now, be honest.
Okay.
Did you even think that the Fed was actually going to lower interest rates in 2019?
At that time, David, I didn't think it was likely that we'd see rate cuts, but I thought that they had already gone one step too far. I was surprised that they might go another increase, which they did, of course, in December. And I think that's what they had to pull back from almost immediately. But unfortunately, they strung it all the way out to July 31st. And that's one of the reasons the market has been, going like this, back and forth like a roller coaster.
Sure. In fact, if you think about it, the market really since January of 2018, we're going on 20 months now, where it's kind of been in a sideways channel, if you will. Volatility calming down, then increasing, then calming down again. So what does that mean moving forward? I mean, it's interesting. Usually when the Fed lowers rates, the market they love it. But this time the market looked beyond into the reason why they're lowering rates, and the market initially at least took that rate drop as a negative. You think they're going to continue to do that?
When I look at why they moved on rates, I think, David, because the rest of the world is slowing so dramatically. And the Fed chairman, Mr. Powell, actually addressed that and said, we know that we have a dual mandate. We've got full employment as well as inflation, and we're trying to make the inflation hang around the 2% level and get as many people working as possible. But the problem is that, of course, America sells a lot of stuff overseas. That's not a problem, but it's a problem if those economies are slowing, and they clearly were. And that's why I think he thought we needed to push people more towards investment by taking fixed income down.
So, obviously with that rationale, everybody thinks we're going to see another interest rate cut this month because, the markets are expecting it. But do you think we'll see another one before the end of the year after that?
I do. And I wish, David, that in July they would have done 50 basis points, in other words, 0.5%, because I think then you can get out ahead of the bond vigilantes and everybody else out there. Rick Reeder over at BlackRock said virtually the same thing. He said, look, the market is the 10-year bond, and the trading is basically the 2-year. And the only way you're going to get the 2-year to drop, because the problem is when we invert, the 2-year is higher than the 10-year. And that tells people, man, there's no real reason to be in the markets. People must be afraid of the markets. You need to knock that 2-year down, and you only do that, I think, by making a rather dramatic cut rather than a small cut. So I wish they would have done 50. The fact that they didn't means I think they're going to do 3 instead of one big 50 basis point cut.
Great. You know, it's funny, I always accuse a lot of the people that are on television, people like yourself, of being what I call stock market cheerleaders, always saying the market's going to go up no matter what. What I love about you is you have a very common sense approach to it. So we come back from the commercial break, and I'm going to talk to you about what you think the chances are that the Fed can make all the right moves, even with what's going on abroad, to keep the markets going strong. So stay with us, please. And you stay with us also. We'll be right back here in a minute on the income generation. Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it, like it did for many Americans during the financial crises that started in 2000 and again in 2007? Would you be willing to downsize your lifestyle and make do with less? Would you be able to go back to work? Whom would you call first? The sad reality is that trusting your typical stock market-based financial advisor to handle your retirement is more like gambling. And who wants to gamble with their retirement? I'm David Scranton, founder of Sound Income Strategies, and there is a safer way investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession, better protect your savings against stock market risk, and establish renewable streams of income you can count on during retirement. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started on the path to an income-based retirement plan.
Would you take your grandchildren out for ice cream and try to pay for it using your stock certificates? No, that would be ridiculous. Instead, you would use your income. So why then do so many retirees make one of the biggest financial mistakes, dipping into their savings instead of relying on income during retirement? The good news? It's completely avoidable. To learn more, visit theretirementincomeStore.com.
Now, despite all the storminess and these mounting fears of recession that we've seen so far, there have been no materially bad news to trigger a sustained stock market drop. Since January of last year, there have been some dips of, let's say, 10% or more, which is steep enough to technically count as a correction. But so far, the market has always been to recover and even to eke out another peak high, as I mentioned before, as recently as July. And that may be partially because we're in the midst of all this escalating fear over the trade war, the yield curve, as well as some other issues. Most domestic economic data, though, has until recently remained fairly positive. The Fed has also been doing what it can to keep investors calm, in spite of the president's claims that they haven't been doing enough. Now, as mentioned, in July, the Fed actually reversed its goal of instituting more short-term interest rate hikes in 2009 by instead lowering interest rates again. This was basically an effort to minimize the inversion of the yield curve, although the yield curve remained inverted through a good part of August and the early part of September. What's telling is that the stock market took its first major drop of August less than a week after the Fed approved that 0.25% rate cut. All throughout the era of quantitative easing, the stock market has been hugely influenced by the Fed's actions and has consistently rallied whenever the Fed made a move in Wall Street's favor. The rate cut should have been seen as just such a move. But this time, there was no rally. Instead, there was another drop just a few days later. Now, to me, this suggests that big investors are no longer willing to shrug off multiple examples of bad news to focus on that one example of good news, as they did throughout much of 2017 when the stock market kept setting new records for low volatility and high levels in the market over and over again. Instead, now, they're doing the opposite. They seem to be ignoring multiple pieces of good news, like the rate cut and decent economic data, and instead focusing on perhaps that one piece of bad news or scary news in the media, which more often than not means news about another escalation in the trade war. Now, does this mean that despite the market's ability to rebound from its small correction so far, that a tipping point is imminent, or that the next major sustained correction may have already begun? Well, nothing is certain, of course. And as I pointed out so far, nothing materially bad has happened to keep investors fearful or pessimistic. But the warning signs of a potential tipping point are increasing, and not just in the flat yield curve or growing fallout from the trade war. Separate from the inverted yield curve issue, projections of slowing growth and waning consumer confidence, both domestically and globally, have more and more economists talking about the next recession just in the last few weeks. Bear in mind also that our own economy has probably already absorbed all the benefits of the Trump administration's massive tax cuts. We saw it reflected in GDP growth between 3 and 4% last year, and big investors have already priced that growth into the market a year earlier. So here's the bottom line. The stock market is clearly not the same market today that it was before 2018. It's basically been in a nervous holding pattern now for 20 months, which I believe is a sign that big investors have been keeping one finger on the trigger, knowing that sooner or later, something has to give. And ultimately, yes, I believe that materially bad piece of news of some type will likely emerge and will create the next tipping point, just as it did back in 2007. But don't forget, the warning signs of that tipping point were abundant for more than half a year before it actually occurred. We knew in March of 2007 that the subprime mortgage crisis was brewing. Yet for all that time, the volatile markets shrugged off all the warnings. And as a result, many everyday investors whose advisors also shrugged them off ended up getting caught in a devastating downdraft. Could this happen this time? We'll talk more about that coming up in just a bit. Now it's time to bring back John Najarian, well-known investor, money manager, media analyst on CNBC's Halftime Report and Fast Money, co-founder of Investitute, and most importantly, friend of the income generation. So John, thanks for sticking around.
Thanks, Dave.
And tell our income generation members, who do you think is going to win this tug of war? We get the central air conditioning from abroad, essentially trying to cool down the stock market because the economies there aren't doing so great. In our country, although business investment has come down a bit, consumer spending is still pretty hot, and the Fed seemed to react more quickly this time with dropping rates. So can the consumer spending and the Fed, i.e. this little space heater, can it defeat the central air conditioning in this big room called the United States?
Well, the good news, Dave, is that you've identified that the consumer, the U.S. consumer, which is 70% of our economy, is still very strong. And I think with interest rates pushing even lower, you're going to see a lot of us, I count myself in there, refinancing and having more money to spend because I'm going to be spending less of that money on whether it's car loans, credit cards, or my mortgage. And I think that's a real positive. So that'll continue to boost the U.S. consumer. And again, I think this is a good thing for our economy, and it's something that they wish they could do overseas.
What does the Fed need to do, in your opinion, to take this business confidence that's starting to wane a bit and to bring it back so that businesses are willing to spend with confidence again?
Well, I think there's only so much the Fed can do, quite frankly. They're pretty good at cutting rates when they need to, and they're also pretty good at raising rates when they have to sort of mitigate the boiling over that you might have if everybody is just pushing inflationary pressures to the upside. That's not the case right now. So I think the Fed is doing about as much as it can. Other than this, I think the biggest thing that'll drive our economy right now is a trade deal with China. That seems more and more likely. The president just extended out by 2 weeks. He basically said, hey, I'm going to give us breathing room, and I'm going to basically offer an olive branch to China. Let's see if they take it. And I think they will.
So you were slightly cautious when we spoke 9 months ago about the markets, although pretty optimistic. You seem to be more cautious now. Is this the type of thing that you're going to be talking about at your Investitute conference, which I believe is coming up next month? Is that correct?
Yeah, we're going to be doing a conference in Vegas, October 4th and 5th. And we've got some just big heavy hitters, Anthony Scaramucci, Kevin O'Leary, Mark Fisher. My brother Pete and I will be speaking there. There's a whole bunch of folks that are going to be giving guidance as to the most likely places where people can go to make money right now, whether that's in stocks, options, futures, or crypto. We're going to have all of that on stage, and should be 400 or 500 people. Should be a great time. I wish you could be there, Dave.
I wish I could. I'm actually at another conference in Naples, Florida at the same time, unfortunately. So 30 seconds for our income generation members that can't be there, who are 55 years or older. What's your best advice for them?
I would say they should be invested right now. Martin Zweig says that. David Kotai of Cumberland Advisors says that. I'm saying that if you're taking rates down, that's going to be good for stocks. So I would be buying stocks here and holding stocks that I already like.
Okay. So now 20 seconds, the most important question of all. Who are your two favorite candidates right now for the Super Bowl?
The Vikings. And gosh, this is a tough one, but I still think New England. Tom Brady still seems to have it, my friend.
I know, even without Gronkowski and other players, it's amazing what they can do over there.
Yes,
so year after year. So again, thanks so much for being a part of the show. We really, really appreciate it, John.
I appreciate it too. Thank you, Dave.
Stay with us. We'll be back here in a moment on the income generation.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently, some fixed income investments have actually outperformed stocks. But yet, you're still waiting to act. Visit theretirementincomeStore.com today to regain control of your retirement.
Now, although the tipping point that ushered in the last major market correction occurred in late 2007, the warning signs were in place long before that. In fact, if you're a regular viewer, you've heard me talk about Wall Street cheerleaders and about how the need for corporate CEOs is there to always speak optimistically about the stock market and about how that optimism spreads throughout various parts of the market through the financial media, and it even influences many financial advisors. A recent Market Watch article provided a sampling of what some cheerleaders, as I call them, were still saying just a few weeks before the last major market crash began. I'm ready to be a bull again. The housing market is beginning to show serious signs of bottom. Quietly, the financial sector has been slowly healing. That, of course, came in 2008 as the market started already going past its tipping point, but really hadn't taken its big drop as a result of the subsequent failure of Bear Stearns. Or how about this one? For the next few weeks at least, the sun seems destined to shine on the stock market. The the credit crisis seems to be reaching a conclusion. All these factors have lessened the downside risk in stock prices. Again, that also, toward the summer of 2008, thinking, okay, the market's down, we're not going to go down much more than this. Of course, ultimately dropping nearly 60%. And how about this last one? The subprime mess is largely behind us. I think a 75% invested posture is about right in this juncture. Think about that. Having 3/4 of your savings in the stock market and watching it shrink by almost 60% over the course of the following year or so. Here's the point. The stock market cheerleaders are always going to keep right on cheerleading regardless of any warning signs. Cheerleading right to the bitter end. If you've ever been to a football game, you know it can be difficult not to pay attention to the cheerleaders. They make a lot of noise. Sometimes they can be far more entertaining than the game itself. Well, the same goes for Wall Street cheerleaders. They make a lot of noise and their ever-optimistic message can be appealing. That's why it's so important to find the right objective financial advisor, a fiduciary whom you know is putting your financial interests ahead of his own and ahead of Wall Street's. Now, with that in mind, I suggest remembering two important things whenever you encounter a market forecast these days that has a cheery rah-rah ring to it. One is the fact that, as we've noted, the stock market has been in a shaky holding pattern now for over a year and a half. A sure sign that not only is the market topped out, but that nervous institutional investors do have one finger on the trigger, ready to pull out as soon as we've hit the next tipping point. The second is that the inverted yield curve exists and what it signifies. Now, as I've mentioned before on the show, when it comes to anticipating economic trends, the bond market is always said to be smarter than the stock market. And a good example of this intelligence occurred last December when the Fed announced plans to raise short-term interest rates for the fourth time in 2018. Prior to that, bond yields always increased when the Fed announced a rate hike, giving the Fed typically enough room to make that rate hike without further narrowing the spread between long-term and short-term rates and risking a flat yield curve. But in December, that came to a screeching halt. Anticipating slower growth, the escalating trade war, and other red flags, the bond market said, enough is enough, and didn't budge. Long-term interest rates have only fallen since that time, and the yield curve has inverted fully for a pretty significant period of time in the late summer. So much that the Fed has now had to reverse course and is lowering federal funds rates again, as we talked about before. The important point is that the bond market has been sending a clear, unwavering signal about where the economy is likely headed for almost 10 months now, even as the stock market has exhibited wild uncertainty. Again, the bond market is said to be smarter, and that assessment is based on its record of anticipating trends throughout history. Also bear in mind that falling long-term rates also represent a flight to quality, as many investors move assets toward the relative safety of bonds while keeping that one finger on the trigger with their equity portfolios. Now again, these are important points to keep in mind when you hear these Wall Street cheerleaders all trying to downplay the significance of all of today's warning signals. They're likely to keep cheering right into the bitter end, just as they did 11 years ago. So be aware and stay informed. And now it's time to bring in our next guest and a good friend of yours truly, as well as the income generation, Scott McLean, CEO of McLean Advisory Group in Waretown, New Jersey. Scott also has a new book coming out really soon called The Three Blind Mice, How Today's Financial Planning Process Leads Your Money into a Mousetrap. Scott, thanks for gracing us with your presence and being back on the show.
Thanks, Dave. Thank you for inviting me.
So let's get right to it. The markets, right? Yeah. Since January of 2018, the markets have been volatile. They've gone sideways for 20 months. It seems like big investors have one finger on the trigger waiting for the next tipping point. What are some of the tipping points that you see on the horizon that could cause that next market downturn?
You know, Dave, I see just recently as you listened to Mr. Trump wanting to reduce the interest rates to zero or lower, I guess, to compete. And that's a real big challenge. I also see the people want to make a lot of money. It's almost like putting Jiffy Pop on the oven. You want to make it simple. This is not a simple time. You just don't rub it and heat it and pop up your popcorn. Things could be a big bubble. And that's what I'm concerned about for our clients and people we speak to.
Now, markets are not set it and forget it 100%. But
no.
The drop in interest rates, you know, if anything, I think the drop in interest rates could be competitive because it lowers our dollar, which could help our trade balance with any luck competing against China's currency battle. If anything, it makes stocks look more attractive, the market look more attractive. So what do you think when you think that the drop in rates is actually a negative thing for the market? What was going on that you're in your mind that you're projecting out?
Negative part could be we could start seeing banks, because they're not making any money, you're going to start seeing banks charging fees up the wall. We could see that change drastically. Although the good news could be we could refinance our houses for lower, but maybe the thought would be, how many people are in that much debt? Maybe the debt will go lower. I don't see the credit card debt going down either. They're different. They could be keeping those rates real high. People are in trouble if they have a lot of debt.
Well, you're right. Yeah, I hadn't thought about that, but you're right. If we get down even near negative interest rates, let alone into negative interest rates, then why do banks want to lend? And if banks don't really want to lend, the economy comes to a screeching halt, the stock market goes down. So normally drops in interest rates are a good thing for the stock market, but it sounds like what you're saying is because rates are already so low that if we drive them down even further, that this time it might be bad.
Yeah, it's a good and bad thing, I guess. It's like you got to get surgery, but you don't want to go through the pain. Well, I think we're going to be going through the pain. We've got to be competitive, like you just said. Europe's doing the same thing. Europe's kicking our butt on the exporting, and the problem is we got to export too. So there's some challenges big time going on.
Do you think that's why when the Fed lowered rates in June, that this time instead of the market being happy that they got more of the drug they wanted of low interest rates, that instead the stock market dropped on the news of the interest rate cut? Maybe you're onto something. Maybe that's what the stock market was thinking.
Yeah, I totally agree, Dave. I think we're in for a different market, a different climate. Janet Yellen, if you remember just 2016, Janet Yellen and Bernanke both talked about the the low interest rates and or zero interest rates.
15 seconds. What has to happen for the stock market to defy gravity and to stay strong for, let's say, 2 more years?
Wow. I think the first thing is we've got to see real economics come in, or are we really producing or are we not producing? Is our top line growth versus our bottom line growth? What are the manufacturing? Are we shipping goods across or are we not shipping goods? I see perhaps you oversee maybe could other countries take advantage of China?
Sounds like we got to win the trade war too, is what it sounds like you're saying. So, Scott, thanks as usual. I'm sorry to cut you off there. We need to take a commercial break. We'll get you back some time. We have more time. You stay with us too. We'll be back here with more on the income generation coming up in just a moment.
After a certain age, you shouldn't be overexposed to stock market risk. Yet, you might still be trying to squeeze every last drop out of today's market. And although fixed income investment can offer less risk than stocks, it doesn't mean you have to sacrifice return. In fact, recently, some fixed income investments have actually outperformed stocks. But yet, you're still waiting to act. Visit theretirementincomeStore.com today to regain control of your retirement.
So when the Federal Reserve meets again in just a few days, they're widely expected to cut short-term interest rates even further. Why? In an effort to try to stabilize the shaky markets and narrow this inversion of the yield curve that existed right through the beginning of September. Thanks to China, they also now have another incentive to lower rates. In August, China devalued its currency, which is, we call it a cheating strategy that governments sometimes use to try to gain trade advantage. One way for the U.S. to combat the move would be to devalue the dollar. This would require lowering interest rates. But what does it all mean in the broader picture? Well, for years I've been pointing out that one of the potential outcomes of all the artificial stimulus that we've pumped in the economy since the financial crisis is that we could end up becoming the new Japan, whose economy has been stuck in a low interest rate environment now for decades. Other economists have also noted that low interest rates could become the new normal. And this is a global comment by many of them. And today, the evidence for that scenario is stronger than ever before. Many countries throughout Europe and around the world also have inverted or partially inverted yield curves. And that's right now as you're watching the show. And even some that don't, let's say like Germany, does not have an inverted yield curve, but yet almost all their interest rates amongst the entire yield curve are in negative territory. So I believe we might actually see a negative Fed funds rate once the next recession hits. Although challenging, this environment does give me and other income specialists a golden opportunity to demonstrate why investing for income is a sound strategy for investors over the age of 50, regardless of market conditions. For one thing, the shift in direction of interest rates from rising back to falling means that the headwind for bond investors overall has ended. On the other hand, a low to falling interest rate environment can make it challenging to get good competitive yields on bonds and bond-like instruments, as I'm sure most investors can imagine. Which is why I pointed out that I've been anticipating this challenge for years, and that anticipation is why I modified my business model 4 years ago to focus on active management. Active management of bonds and bond-like instruments gives income specialists the opportunity to turn these challenges into opportunities on behalf of our clients. And for investors who've already been using income-based strategies throughout the current long-term secular bear market cycle, once the next major correction does hit and reaches that point, well, yeah, that may just present another great opportunity for them. At this time, those with the right risk tolerance might want to consider getting back into the market as capitalists, again in the future, once the stock market takes that third major correction. And now they can be capitalists instead of being victims and saying, woe is me, I just lost all this money when the market dropped. Let's face it, that's why the rich get richer, because when the market drops, they buy. Unfortunately, we're trained by the stock market cheerleaders to be fully invested at all times, so that way we're stuck being in the role of victim once the market drops. I urge people to have enough cash on the side to become a capitalist instead and take advantage of that market drop. In the meantime, though, consider carefully, also with your advisor's help, whether your current market exposure is appropriate in the midst of so much storminess and so many current red flags. Now let's welcome our next guest and good friend, Eddie Ghabour. Eddie is the co-owner of Key Advisors Group in Lewis, Delaware. He's also the author of the new book, Common Sense Bull. Operative words being common sense. So Eddie, thanks for being back on the show here today.
Thank you so much for having me, Dave.
You know, we talk all the time because we talk on the air, we talk off the air, and I know that you were pretty bullish for a while with the stock market, conservatively speaking. But now that's turned to being more bearish, and I don't mean just in the last month and a half, I mean even slightly before that. So what initially caused, in your mind, your turn from being more bullish to bearish a couple, 3 months back?
Well, you know, the main thing is I track interest rates very closely, as you well know. And as the yield curve started to flatten and then become inverted, that's a big red flag for us. Plus, looking around the globe, everyone seems to be heading into a recession overseas. And as you well know, we are a global economy. In my opinion, it's impossible to have the entire world around us go into a recession and it not have a negative impact on us. Couple that with the fact that we've had unrealistic gains in the market. Yes, I've been bullish and it's fantastic, but at the end of the day, we always tell our clients we're going to be disciplined and most importantly, not greedy. So we have become a lot more defensive in our strategy right now because I think as we head into the fourth quarter in 2020 being an election year, we're going to see a tremendous amount of volatility, and it wouldn't surprise me if we start to see some corrections along the way as we head into next year.
30 seconds left in this segment. Why is the inverted yield curve such a big deal?
Well, traditionally speaking, it's been one of the most consistent indicators when you look back on an average of at least 13 months or so that there's a recession ahead. And look, some people are saying it's different this time. I'm not one of those that believes that.
We need to take a quick commercial break, Eddie. Stay with us. And you stay with us too. We have much more coming right here on the Income Generation. We'll be right back. And welcome back here to The Income Generation. I'm David Scranton, and we're talking to Eddie Ghabour, co-owner of Key Advisors Group, also the author of the new book, Common Sense Bull. So Eddie, I see what you're saying about internationally, but yet so many people today are pointing to the consumer. Consumer spending is still strong. They're pointing to the fact that if consumers just ignore the media, they can continue to spend, they can keep the economy going reasonably well. So is it possible for us to still have a relatively strong economy, but start to slip into a downward trending stock market because all the pressures around the world? Or do you think we probably have to go into recession to see the stock market turn?
I think what you're seeing right now is typical late cycle, right? Where the consumer is really strong, the market's having its, we'll call it one last run up. But look, right now, the consumer is what's keeping the economy afloat. When you look at all the other indicators, like manufacturing recently went down for the first time in 3 years. Eventually, it's going to impact the consumer. And when that happens, because keep in mind, these tariffs have not hit the consumer yet, and they will. If this trade war extends the next year, it's going to impact the consumer. Then the consumer confidence will go down, then it snowballs, and then you're looking into a recession. And our point is, instead of being reactive to the markets, be proactive. There's nothing wrong with being a little bit early to taking cash and putting it on the sidelines and taking advantage of the big gains that we've seen in the market. And that's our stance. This way, when we do have a correction, you have ammunition to be able to buy that dip.
And I love that thinking, of course. But the Federal Reserve seems like for the first time they reacted quickly, right? They're always slow to react. They want to have 4 interest rate hikes in 2019, and they had 0, and they immediately reversed course and are now dropping rates. So are they acting quick enough? Could they stave off the recession, next stock market drop, at least for a while? Or is it not going to be enough?
So I don't think we're going to see an imminent crash. That's just my personal opinion. And I think the Fed is usually, when you look back, they've been a little bit late. Who knows? That December rate hike that they did may have been the start of the recession that we may be going into in the next 2 years. I'm one that believes you cannot stop economic cycles from happening. You can slow them down and put Band-Aids on it, but at the end of the day, these cycles are going to happen. And it's been a long time since we've seen a recession. The signs are starting to show that there's some weakness, and I think investors need to take it seriously because, again, when I hear people say this time is different, I've heard that one before, and they've been wrong.
You don't have to stay and buy and hold in the markets. Having a little cash reserves allows you to be a capitalist and buy in upon the next drop. I love your thinking, Eddie. Thanks so much for being back with us here on the show.
Thank you so much for having me, Dave.
And you stay with us. We have more here right on The Income Generation. I'm David Scranton, and we'll be right back. I'd like to thank all of our guests for joining us today for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. As I've said many times on this show, no one has a crystal ball. And anyone who tries to tell you that they know for certain what's going to happen with the economy and the markets in the next year or two is frankly lying. No one can know for sure. And yet staying informed and educated about the factors that influence market trends and about the compelling lessons of market history is crucial. That's especially true if you're retired or within 10 years of retirement, and in the light of all the storminess and all the uncertainty brewing in today's markets. Be aware, for example, that the U.S. yield curve has been for a good period now up till the beginning of September inverted, and that inverted yield curve has preceded pretty much every domestic recession since 1955. Be aware that part of the reason for its inversion is that the bond market has been sending a consistent warning signal about shrinking growth since December of last year. Also, be aware that the stock market, despite briefly hitting new record highs this summer, has ultimately been in a nervous holding pattern and trading sideways since January of 2018. And be aware that while no materially bad news yet has emerged yet to tip off the next major sustained market correction, it could happen at any time, just as it did at the end of 2007, when the subprime mortgage crisis ushered in the Great Recession, marked by a drop of nearly 60% over 18 months. And remember that many Wall Street cheerleaders kept forecasting continued growth for the stock market even almost a year into the Great Recession, and before the market really fell off a cliff. Be aware that the current environment of high stock market risk and low to falling interest rates has been building for years now, and that some visionary advisors have proactively prepared for it. Those are advisors who specialize in actively managed income-based strategies designed to reduce your market risk and protect your principal, all while generating interest and dividends at competitive rates, even in a challenging environment. And finally, please know that with the market still in this holding pattern, right now is an ideal time to reduce your market risk. How? By making that strategic shift from portfolio growth to retirement income. Thanks for watching. If you're close to retirement and really want to know how to protect and maximize your money, it's essential that you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.